Ryan Haslam here to talk about how a great company can be a terrible investment. This is how you can avoid most common pitfalls of stock investing. The tendency with a subject is to oversimplify the decision, whether to buy, sell, or hold a certain stock. Many people are tempted to simplify it down to, well, they're a good company with a good product, and it's sure to be a good investment. But a good company can actually be a bad investment. The two are related, but not synonymous. So what makes a company a good investment? Here are some of the criteria you may want to consider. Number one, take a look at the company's finances. Many great companies with great products or services have gone under simply by mismanagement of their finances. Analysts typically look at the company's cash flow to evaluate how much money the company spends, how much it brings in, and how much free cash is left after all the bills are paid. Reviewing revenues, net income, and earnings per share helps analysts assess the company's history of sales and earnings growth. Another gauge of financial health is the amount of debt the company has compared to equity. Basically, do they run the company the same way you would run your personal finances? With responsibility and carefulness. Stocks of companies that are leaders in their industries generally are desirable choices for a portfolio. Analysts look for profitable companies with limited competition whose products or services are valuable to customers. Keeping an eye on earnings estimates helps analysts determine whether the company is likely to experience rising profits or unexpected slowdowns in the future. This is the big one that many amateurs forget, ignore, or minimalize. But it is what sometimes can make a great company really a terrible investment. It's also the most difficult exercise to accomplish with accuracy in evaluating a stock. Analysts use a bunch of different calculations to assess a stock's relative value. Now, I'm going to warn you, there's going to be an obnoxious use of financial jargon and acronyms, but stay with me. Price to earnings is the first one. Price to earnings ratios, or PE, shows the relationship between the current stock price and the company's projected earnings. The PE is one of the most widely used ratios, and it is used to compare the financial performance of different companies, industries, and markets. The company's forecast PE, which is its PE for the upcoming year, is generally considered more important, by the way, than the historical PE. Price to book ratio, or PB, is a stock's current price divided by its book value. For example, total assets minus total liabilities per share. Both can help identify potentially undervalued stocks and also may be reliable indicators of investor sentiment. Like most ratios, it's best to compare PB ratios within industries. For example, tech stocks often trade above book value, while financial stocks often trade below book value. The next one, return on equity, ROE. It's calculated by dividing a company's earnings per share by its book value per share. The ROE is a measure of how well the company is utilizing its assets to make money. Understanding the trend of ROE is important because it indicates whether the company is improving its financial position or not so much. The dividend payout ratio is calculated by dividing the dividends paid by a company by its earnings. The dividend payout ratio can also be calculated as dividends per share divided by earnings per share. A high dividend payout ratio indicates that the company is returning a large percentage of company profits back to the shareholders. A low dividend payout ratio indicates that the company is retaining most of its profits for internal growth. Starting to get overwhelmed? All right, hang on, we're not done yet. Last part. The personal factor, emotional factor, is another pitfall that is easy to ignore when you're really excited about a stock. While metrics are critical to analyzing a company's stock and whether it may be a good addition to your portfolio, your personal circumstances, for example, your other portfolio holdings, your goals, your time frame, your risk tolerance, those should always be considered when determining whether a stock is right for you in particular. You may need the money in 6 months, so a stock investment may be totally inappropriate for such a short time horizon. Or you may already have a large position in tech companies, and the company you're evaluating may be yet another tech company. In such a circumstance, you may want to consider diversifying. If all these fairly complicated factors are beginning to overwhelm you, You're not alone. If this stuff were easy, everyone would be brilliant multi-million-dollar investors. At Hesen and Haslam, retirement income specialists, we actually believe in completing a comprehensive, personal, goal-oriented analysis before even deciding on any investment strategy. We believe this is the best approach to avoid common investing mistakes by encouraging objective analysis of your goals and your strategies. Please share this fun and informative video with a friend by clicking on the share icon below, the little arrow. Also, don't forget to like the video and to subscribe to our YouTube channel.